Well, what a week. In this week's update, you just have to respect the price action and not the logical outcome. Gold gets absolutely smashed. Another rotation is now being confirmed, and we'll have a quick look at Bitcoin. My name's Garry Davis, and as always, this is general advice only in this video, and please remember to like and subscribe to the video. Well, it was really an extraordinary week, and there were a few things that made logical sense and several things that didn't make logical sense at all when you've got inflation on the rise, when the Fed makes a shift, a significant shift really, in their policy stance. Beg your pardon. So let's look at what was logical last week. First of all, with inflation rising and the Fed now talking about raising interest rates earlier than what they had previously foreshadowed, then you would expect the US dollar to go up, and it did. And with the US dollar going up, then of course that puts currency pressure on commodity prices, and so you'd expect to see commodity prices fall, and they did. So that all made sense. But what was completely illogical is that bonds were bought, which made yields fall. Now, why anyone in their right mind would want to buy bonds when you've got inflation moving higher defies any sort of reasonable examination. And I'll get to the obvious conclusion from that in just a second. We also saw equities rotating back towards the aggressive areas: consumer discretionary, technology, communication services. Now that makes no sense at all, and all year at the slightest sniff of inflation, then yields went up and tech stocks got sold, and got sold heavily. But in the face of, we've now got not just conjecture about inflation rising, but we've now actually got the hard evidence, and we've got a shift in Fed policy, and yet money is rotating back into the technology sector. So that made absolutely no sense whatsoever. And so the only conclusion that one can reach is that Wall Street doesn't believe that inflation's an issue. Otherwise, bonds wouldn't be being bought and money wouldn't be flowing back into the aggressive sectors of the economy. So that, that is the only rational conclusion that can be reached. Now, the week was pretty volatile, but I think it really just confirmed what was said last edition, and that is that we had a rotation back away from the reopening stocks, the stocks that had done really well and outperformed since November of 2020 through to now. But just a week or so ago, we started seeing money rotate back again, and that didn't change. That wasn't interrupted by what was a very significant week with hard inflation data and a change in Fed policy. So that was what I said last week, and it certainly followed through. So technology, I think, is poised to make a comeback. And really, when you look at it, when you look at the fundamentals, why not? Fund managers are grossly underweight technology from all the selling that's occurred this year, at the same time that the company fundamentals are just getting better and better, and to a degree better and better at a faster rate. And of course, prices are well off their highs. So when you put those three things in the mixing bowl, it's pretty obvious that technology can make a comeback, even though it's not the logical conclusion that you would come to. Now, the best technology stocks and the best consumer discretionary stocks have got extraordinary pricing power. They're the ones you want. You don't want to just buy anything in technology or the other aggressive sectors. You really want to zero in this sort of environment where interest rates may or may not go up sooner than expected. You really want to zero in on the ones that have got a strong balance sheet. They don't have a lot of debt. They've, in fact, may have net cash on their balance sheet, and they've got extraordinary pricing power. These are the stocks that are going to do incredibly well as we go forward. The big picture reality that we have right now, and it's like no other time in history, not even close, is that we've had ultra low interest rates for such a long period of time. You know, interest rates have been really low for longer than that is the normal situation. We've also got this extraordinary amount of liquidity as well. You know, there's no question about that. We've got miles more liquidity than has ever been the case in the past. And all this is happening at the same time that we've got the highest GDP numbers ever seen. And in the second quarter forecast for this year in America is for 10.5% GDP growth, and for the full year it's 7%. You know, they're extraordinary numbers when to be coupled with all that liquidity and low interest rates. Then it's no wonder that the market is continuing to do pretty well. So where should the emphasis now be? Well, not entirely, but it needs to shift back towards the more aggressive sectors. And we also saw renewable energy start to perform better in the last 2 weeks as well. So that's the reality of the market. Whether you agree with it, whether it makes logical sense to you, that is where the money's going. And if you want to make money in all sorts of time frames, then you've really got to go where the money is flowing. Now, I'm not saying that we should abandon other sectors that are still in favour, because not all the sectors that have done well this year are going to fall out of favour. One of them is financials, which had just been such a leader all year and really has broken down quite badly. So that's probably one that you definitely, need to move to underweight on. But not all the sectors have been impacted as much. So I think the case for having a more broadly based portfolio is certainly there. But compared to 2 weeks ago, the balance needs to shift back towards some of the more aggressive sectors. All right, just before I get into American stocks, let's just look at a couple of charts. We'll start with the Bitcoin chart. So we're still within this overall consolidation between, call it 30,000 and 40,000. And who knows how much longer that may continue for. So there's really not much more to say on that score. I mentioned about bonds, the fact that bonds had been bought. We saw during this period from January, so this is a weekly chart, this is the 20-year composite treasury bond ETF. So all year, bonds were being sold, which pushed the yield up because of expected inflation. So we'd moved from around 158 and we got down to mid-130s, and that's quite a large move for the bond market. Now, so that was in expectation of inflation. Now, inflation appears, the Fed confirms it, and yet now we're seeing bonds bought. That's completely illogical. And so, therefore you have to conclude that Wall Street just doesn't believe it, or they think that it's only going to be quite transient. And you can see the volume that really kicked up in the last week. So this is quite a concerted move into bonds. So bonds are being bought, that pushes the yield down. If we look at the spreads, some of these important spread numbers that I look at, this is the Russell growth versus Russell value ratio that we've been looking at for quite a long time now. And you can see it's very, very clear. Money is moving back into the growth sectors of the market. Absolutely no question about it. And it's happened very strongly and very quickly. If we look at consumer discretionary versus consumer staples, we've moved off the bottom of this range, and again, we've moved quite sharply. So there's just no question about the move back into those sectors. And you might argue that, well, look, it might just be very temporary. It might just be for a week or two. But the key point that I would make is that this is occurring at a time when it shouldn't. when inflation is rising and the Fed's changed their policy stance, and yet we see a dramatic acceleration back into those areas. Now, nothing is guaranteed in the market, but that signals a high probability that it's probably going to continue. And there certainly are some other indicators that that I've been talking about with members that would confirm that as well. So let's jump in and look at the American market. The S&P ended up losing just a tick under 2% for the week, and as I've been saying, the rotation is well and truly underway. And so some sort of shift in your portfolio is warranted. If you want to stay where the money flows are going in the short to medium term as well. Now, some investors might just want to be really long term, just effectively buy and hold, and that's okay. But one of the consequences of that approach is going to be that there are going to be lengthy periods. We've just come through 6 or 7 months where technology was well and truly out of favour, and price falls of 30 to 40% were quite normal. So if you're a long-term investor that has the stomach for that sort of situation, then fine, you don't need to do anything. But the vast majority of people do not fall into that category, and so therefore really we are forced to shift our balance in our portfolio according to where the money flows are going. Now, the US dollar spiked up quite a lot, as we'll see, to 92.2. We saw the yield initially spike to 1.6, but then it came back down very sharply and basically finished unchanged where it started the week at 1.44%. We did see the VIX spike up to 21, so there certainly was a reaction at that level, but it's really more about rotation than about money leaving the market. So I just want to highlight a couple of other things just to illustrate the point. Now, these are not recommendations. These are just observations to validate the point I've been making about the rotation back into technology, as illogical as that might seem. So these are just a couple. I could have put 100 stocks here. So these are not recommendations. But Twilio is a very attractive technology stock that I think has a really good future. There's no denying the price chart, and look what happened on Thursday and Friday following the Fed policy shift. Very strong recovery. Logic would dictate that shouldn't have happened. Square is one of the world's leading payment processing companies. Again, there's no question. You look at Thursday and Friday, money is flowing back into that section. Renewable energy, which had been hit very hard. This is a stock called Enphase that had come off from around $220 all the way down to $110. It had basically lost 50% of its value. But look at the last few weeks, and really good volumes on Thursday and Friday. And just to take it one step further, the ARC funds, which are run by a woman called Cathy Wood, who's a very good operator, has a great team around her, does a lot of good work. But this is the really speculative, high growth, high volatility part of the market. And the ARC funds got hit very hard as well, falling from around $160 to about $100. But look at those funds. They moved up on Thursday and Friday as well. And this contains a lot of long-term, higher risk, more speculative kind of stocks. But even they were joining in. And finally, this one hasn't moved yet, but there certainly are some signs that we've got a base. I like a couple of these volume spikes here. This is the biotechnology index, and it just looks to me like it's formed a base, and the next move could be to the upside. So I just thought those charts would be interesting. Let's get in and look at the S&P. So you can see we had a bit of a sell-off on Friday, but it was options expiry, so all sorts of strange things can happen. So I'd certainly be keen to see what occurs next week with the S&P. I wouldn't be surprised to see the S&P bounce back and perhaps hit new highs in the next week or two. But look, to be honest, in the short term, no one really knows. So it's better just to shift the balance of your portfolio around, because really that's the way that it's working at the moment. Money is not leaving the market, it's just rotating from one sector to another. The Nasdaq, you can see, held up very well. So the Nasdaq had been definitely underperforming earlier in the year, and now that is not the case anymore. If we look at the Russell 2000, certainly some decent selling on Friday night, but again, it's options expiry night, one session. I'll wait until I see a few more sessions next week. Now, if we turn to currencies, this is the US dollar. You can see very, very sharp move to the upside last week. We were down at 90 last weekend, and now we closed at 92.2. So that is quite a sharp move in the US dollar. The Australian dollar certainly copped a hit. It's the lowest level this year, so we've not been under 75 this year. We finished at 74.5, and it's broken some key support, and that has probably fallen more than I would have expected, and quite decent volume on Friday night as well. So we could see some follow through downside to the Australian dollar. Certainly the trends that we'd seen all year have certainly shifted, that's for sure. All right, Aussie stocks, we're down to 74.5, as I said. Our index gained 0.8%. Healthcare majors were really roaring last week. They were certainly the best part of the market. Miners and energy were the weakest part of our market, and small caps again pretty strong. So we'll just quickly look at those couple of charts. So there is the ASX 200. Materials were weak. Energy copped a bit of a bashing on Thursday and Friday, but really it was all about healthcare. An amazing run for healthcare. Very, very strong. And that's why I think we might start to see that follow through as a bit of a global theme, healthcare and biotechnology in particular. And here's the small caps. So Australian small caps, there might be a little bit of a sentiment sell-off initially on Monday morning, but certainly small caps finished very, very strongly. And again, look at the volume pouring into that sector. Now, gold, unfortunately, got really smacked. And again, this is something that is not logical. You would have thought with rising inflation now confirmed that that's generally a better environment for gold. Okay, the US dollar went up, so that had some impact on the gold price because of the currency relationship, but the selling in gold went way beyond just the currency effect. So therefore, gold was being actively sold. So something triggered, and I don't know what it is because it doesn't make sense to me, but something triggered selling in gold. And as we know, futures speculators do determine the price of gold in the short term because they're so highly leveraged. And something triggered selling in the futures market, and it followed through very robustly, as you can see. That's the weekly chart. That's a very sharp move. And if we look at the daily, Wednesday, Thursday, Friday, very sharp selling. Now, if we put a Fibonacci scale on the move from the end of March to the highs in the start of June, we've come back to the 61.8% level, and we've been able to sort of hold that level at this stage. But I wouldn't rule out a return towards the lows that we saw back in March, which is around the 1680, 1690 level, I think is possible. Let's just look at GDX while I'm here. So GDX copped an absolute smashing as well, and you can see the volumes were right up. It is highly unlikely that we're going to see a V-shaped move back up again. So I think what we've seen in the gold market is not going to pass quickly. I think at best we will see a consolidation, but I would place the highest probability on further downside in the gold price and in gold miners. Now that's at the US level. Australian gold miners, the Australian gold price has actually held up fairly well. It's only down a little bit. So Australian gold miners are likely to perform much better than their US peers. Okay, so gold lost $112 down to $17.65. It's not logical, but it is the reality, and we just have to go with that. GDX, just the volume is the one that really confirms it for me. This wasn't only a significant price move. There was a whole-scale rush out of gold mining stocks as well. Turning to other commodities, copper was sharply lower on currency effect, down to 418. Nickel also lost ground down to 784. But look, the reality, particularly with copper, is that demand will keep growing very strongly. I don't think there's any question about that. The decarbonisation theme is bringing forward the projections that were probably made only a year or two ago about the demand. It's bringing them forward by years. The same as we've seen in the electric vehicle market. So demand is going to keep growing strongly. The reality is that new major mines that have the capacity to meet that demand just can't be switched on. Sometimes we're talking 10 years before a mine can be defined, developed and put into production. So it is highly likely that supply is going to be unable to keep pace with the demand. So the outlook for base metals and battery materials is still extremely positive. Now, prices are currently falling, so you know this is not something you probably want to do right at the minute. But I think there's a good opportunity building here in the base metals space. Crude oil held up pretty well. It actually got a little bit higher than this. Did come back a bit with the currency, but still managed to finish the week above 70. So it's proved pretty resilient to the currency. There's the spot copper chart. You can see just how sharp a move we've come down from nearly $4.80 down to under $4.20 in just a couple of weeks. There's the nickel price. Not quite as much selling in nickel, but nevertheless still some selling last week. So to wrap it up, final thoughts. Technology really had become the uncrowded trade. You know, everybody was pushing back into the financials, into the late stage cyclical companies, the reopening kind of stocks, economic reopening stocks, and that had become the crowded trade. And of course, when you get to those extremes, then it really pays to be looking at contrarian opportunities. And I think that the aggressive sectors, technology, consumer discretionary, are clearly putting their hand up now for a monetary rotation back. And as I've been saying, it's at a time when the fundamentals are accelerating, when spending is absolutely booming. So the backdrop for this to occur is actually very solid. Now these comments only apply. There's hundreds, if not thousands, of technology stocks and consumer discretionary stocks. These comments really only apply to where the high growth looks really assured. I think in a rising interest rate environment, there's still going to be a lot of technology stocks that are going to struggle. So you need to be very selective here and just zero in on the ones that have got growth rates of 50, 100% plus per annum. That looks highly likely to continue for years to come. They're the stocks that you're after. Portfolio analyst last week, we did quite a bit on sector trend analysis, which I think members found very useful. There was also an evaluation of an upcoming IPO. and again, multiple trading opportunities. And this week, going to be looking at position sizing when you're in the trading kind of mindset rather than an investing kind of mindset. So I think another really good session in Portfolio Analyst this week. That's it for this edition. There's more information on the website. There's my email address, and I'm sure we'll have another fascinating week. I'll be back with you next Sunday. Cheers.